The used car market, which has seen a steady increase, is now collapsing. According to a recent analysis by Black Book, prices for subcompact cars have fallen by 3.68% in just 1 week, as wholesale used car values plummet. Federal repossessions are increasing, and potential buyers are going on strike, resulting in one of the fastest downtrends on record. Lenders are warning car buyers that their car loan may soon be underwater due to the situation. With the average new car payment exceeding $700 per month, there is concern that the impact will spread throughout the industry and affect the cars already sitting in driveways. To understand the current situation of the auto business, the latest data, and the predicted amount of car price drops over the next few months, we need to look at the big picture. Car prices have been steadily rising over the past few years, outperforming the stock market in 2020, 2021, and 2022. They have also increased twice as much as home prices and 4 times more than contemporary art prices. 80% of new cars are being sold above MSRP, leaving many wondering when it will all come crashing down. Limited production is the first primary category that is coming to an end, which has contributed to the increase in vehicle prices. Making a car requires all the necessary parts, and one of these is chips, which many people overlook. A modern car needs thousands of chips to function properly, and although this sounds like a lot, the auto industry only uses about 3% of the entire chip supply, while the rest is used by consumers. Semiconductors are essential for a car to operate various features, such as windows, sensors, ignition, navigation, and other aspects that often go unnoticed until they stop working. Toyota has already cut production by 50,000 vehicles in July due to a shortage of semiconductors. A typical semiconductor production line can involve up to 700 individual manufacturing processes that take about 14 weeks to complete, according to Kelley Blue Book. Low interest rates are another factor that has made cars more affordable than ever before. However, as demand exceeded supply, the average car payment has risen to over $700 per month, with 1 in 8 buyers paying over $1,000 each month. Consumers' increased disposable income drove up prices, as in the property market. Greed is the third factor contributing to the current situation. Automakers are reducing output to increase profits deliberately. BMW said, "The plan is to clearly stick with the way we manage supply to keep our pricing power at the current level." Mercedes-Benz is also following this path while moving towards the higher luxury end, which may involve renaming the same thing to sound fancier so they can charge more. Ford has hinted at transitioning to a built-to-order business model, while BMW has stated that they intend to maintain their current level of pricing power. The future of the market and the reasons for the decline in car prices are important to understand. Car repossessions are on the rise due to the high demand for cars. This is causing concern for banks, as falling car prices would leave many borrowers in debt, owing more on their car loans than their cars are worth. Banks such as Wells Fargo have reported higher loss rates for loans that originated last year, resulting in increased write-offs. Additionally, the average down payment for cars is only 11.7%, and the average term is 72 months, meaning that people are rolling over remaining balances into new loans before finishing payments on their current vehicles. This trend is unsustainable, and with prices starting to fall, KPMG predicts a 30% drop in used car prices, while Ally Financial predicts a 2.0% decline over the next year. As a result, buyers may quickly find themselves underwater in a declining market. This could lead to more people abandoning their car purchases if they are unable to repay their loans. This, in turn, could cause a ripple effect throughout the market. For instance, if a buyer took out a $40,000 loan for a car that is now only worth $25,000, and they are struggling to make the $700 monthly payment, they might decide to walk away from the loan, causing further losses for the lender. Therefore, the future of the market looks uncertain, and it remains to be seen how car manufacturers and lenders will respond to these challenges. Let's examine CarMax, as their business model is often regarded as quite stable. Customers can bring in almost any car and receive an instant offer valid for up to 7 days. If the customer accepts the offer, CarMax can resell the vehicle for a profit. However, their stock has recently fallen by 60%, indicating difficulties for the entire industry. Moreover, they made it clear that their customers are being hit with a triple whammy, as inflation is making cars less affordable. As previously mentioned, prices have dropped between 1.72% and 3.68% for subcompact, mid-sized, and full-sized cars respectively from 1 week to the next, as rising interest rates make financing more difficult and consumer confidence declines. Additionally, dealers have been shifting inventory from auction to retail in hopes of getting a higher price, which has led to an increase in supply and further price declines. Carvana, the used car retailer famous or infamous for its 24-hour car vending machines across the United States, where customers could literally walk up, insert a coin, and drive away in a used car, was the pinnacle of 2020's euphoria. However, Carvana has lost an average of $3,255 on each vehicle sold, and its stock has dropped more than 95% this year. In terms of what's happening today, first, Wells Fargo reportedly tightened underwriting standards after it saw signs that borrowers were falling behind, resulting in a 40% drop in the volume of auto loans originated by the bank. The bank goes so far as to say that borrowers are now debating whether or not it's worth staying current on their payments, which could be difficult. Second, the price of automobiles is starting to fall, having doubled from their pre-recession highs. The current situation in the automotive industry is similar to what has happened in the past with homegrown tech stocks such as Shopify, Netflix, Zoom, and Pelican, among others. Recently, CarMax's stock has fallen by 60%, which indicates trouble for the entire sector. Inflation is making cars less affordable for customers, and rising interest rates are making it more difficult to finance them. Carvana, the used car retailer famous for its 24-hour car vending machines across the United States, has lost an average of $3,255 on each vehicle sold, and its stock has dropped more than 95% this year. Wells Fargo has tightened its underwriting standards due to signs that borrowers were falling behind, which resulted in a 40% drop in the volume of auto loans originated by the bank. This situation is causing banks and automakers to experience significant losses, which is likely to decrease the market as a whole.